Hey, good morning, our real estate pros. You've got Dan Noma here and our friend from managethefunds.com, Henry and Horn Wealth Management, Mr. Michael Carlin. Michael,
Good morning.
thanks for hopping on with us, man.
Oh, you're most welcome. You're
Yeah.
most welcome. I don't know if I need like a signature hand wave, but I was thinking about it just then. I think I'm going to take a
Signing
pass
off.
for now, though.
Yeah, well, maybe to go with the Mr. Rogers, like change your shoes and, in and out. I think that'd be a good way to do
Hey, dude, I'm working from home. You think I'm even wearing shoes?
it. Let's just hope you're wearing clothes. Yeah.
I'm wearing, don't make me show you. I'm wearing clothes.
Well, so, a lot's going on. Housing is so far so good. I think that, we've learned a lot about the resiliency of some of these markets recently, and what the PPP money did and the stimulus packages rolled out, and how those things have actually started to really, really impact and work. It seems that the market's responding. So just curious to, the last 30 days since we've talked, what's your kind of, I know it's been a little bit of a roller coaster, but,
Yes.
the last 3-4 days have been great. So,
Yes. Well, and it's been, so let's just kind of broadly speaking, paint the
yeah,
picture. It has been a ride higher since we met last as the market continues to see through some of the economic dislocations. And what encapsulates this best, Dan, is the move that we saw with the jobs report last week.
yeah,
The jobs report last week, the expectation was 7.5 million jobs lost, 19.5% unemployment. Instead, it was 2.5 million jobs gained, a miss of 10 million, unemployment closer, like a little bit less than 13.5%.
yeah,
That is a seismic miss, the likes of which no one has ever seen before. And the shock and awe that the market endured, what you saw was a complete reversion where all the things that weren't working, your airlines, your hotels, your hospitalities, all of that, all of the things that weren't working immediately were flooded with capital and surged higher. And all the things that had been working, your growth, your tech, it took a pause. So it was a seismic move, and one that surprises me that the economists were so wrong. I know hundreds of businesses just locally that took PPP money,
mhm,
and those businesses were forced to keep, maintain, and in many cases bring back employees.
yeah,
So the question is that we all know that PPP money will be running out. What is the economy and job market going to look like when it runs out?
right,
Will there be an extension? And what will happen with unemployment benefits at the end of July? Will that be extended? Because the housing market, the economy in general, all of it is being supported right now by that government bailout.
yeah, yeah. It's like we talked a little bit about this yesterday, but it's pretty amazing. We're hearing a lot in our community, but even in just my little office, the sheer volume of consumers that are jumping into housing right now. And I've tried to quantify this and put math behind it and tried to, chart it out and think about why, right? Because obviously I want to target more of these people if I can. And I can't really put my thumb on it. It just seems that it's like the buyers have super high intent. Like it's a different buyer than I remember seeing 6 months
Mhm.
ago. This
Yep.
buyer that's out looking today, they want to buy now. They're looking at less houses. They're ready, willing, qualified. They've got jobs and they're ready to rock and roll, and they're coming in droves. And
Mhm.
it seems that this message that, there's going to be some kind of reset to the market, housing market at least, has gone away, right? And we're just not hearing any signs of any kind of blood in the water, so to speak, from any of the investment groups. I mean, the rent collection's been fantastic, but to your point, who knows, right? That if it's sustainable due to the fact that it's being kind of lifted up. by PPP funds or unemployment funds or whatever that may be. But so far so good, and
Yeah.
I'm cautiously optimistic.
Well, I'm going to give you a few things to think about.
Yep.
Number one, during the recession of 2008, the economy was running at 95% capacity, which was a recession of 2008. With the economy shut down and GDP somewhere around the -30, -40% in the second quarter, and there's an expectation now that there'll be a pretty big snapback in the third quarter. Are we even over the whole calendar year of 2020, are we going to be running at 90% capacity? And think about what the recession was in 2008 at 95%. Will we be running at 90? It's unknown.
Right.
And you look at the demographic trends. So when you look at household formation for millennials, they are in that age range that they are old enough and they've been renting long enough that there's this kind of this undeniable baby boomer like in the early 1980s trend toward housing. And if you look at the baby boomer, and I encourage all your real estate pros to do that. Look at the real estate market of the 1980s, and take a look back to see what baby boomers who were starting to form households, what they were doing in the residential real estate market, even though mortgage rates were 15, 16, 17% at the time.
Mm-hmm.
It was an undeniable move, even though the numbers didn't make a whole heck of a lot of sense. Unfortunately, they were battling inflation. They had to raise interest rates in order to combat it. We don't have that situation right now. Yet we have the demographics moving. We have the people leaving the suburbs, leaving the urban areas into the suburbs. We know those things are happening. We know that Arizona is one of the top few states in the United States attracting people every single day. It's hard to ignore both the demographic trends, what the data is suggesting about people continuing to move here, and the type of jobs in the job market that Arizona continues to attract. And look no further than that huge semiconductor plant that should be starting here at some point soon. So we have everything working for us in Arizona, so we're insulated. This isn't like, and there's no harm in being from Nebraska. I'm not saying that, but there's different demographics there. You got farms shrinking and people leaving versus the kind of market where we have here.
Yeah.
So Dan, I would expect to see continued growth in the residential real estate market, particularly here in Arizona. The expectation was for a 5% rate of growth in residential real estate pricing over the next 12 months. That has come down, but it's come down to a 3% rate of growth. Go figure.
Yeah. I mean, and you're even seeing now some of our national builders have looked to Arizona again. Shea Homes just purchased another giant parcel here in Paradise Valley. So, national
Demographics.
builder, yeah. And, that's an 18-month runway to just kind of turn dirt or maybe even put a shovel in the ground to be able to start building homes. So they must be projecting out pretty far in their hope that, housing is sustainable. So I think that's great. I guess, kind of in a bigger picture, what are your thoughts on, we're starting to see our election signs pop up all over the city. I'm traveling a little bit and I'm seeing them out and about kind of everywhere. So, election's coming, right? I mean, November is not too far away. Mm-hmm. What kind of trends and things, should we or could we potentially expect, from here to the end of the year with related to just kind of the economy in general, assuming that, COVID and, all the other issues that we've got are constant. Mm-hmm. What are your thoughts on where things go, in relation to the fact that we're in an election year?
Well, is it going to surprise you to say I'm going to start with the data suggests?
No.
Is that shocking?
No.
Okay. So the data suggests, Dan, that when you have a presidential election cycle where the incumbent party loses, the market tends to go down closer to the election. Okay?
Yep.
So what I'm telling you is, right now, that you go to sites like predictit.org, which is probably one of the better nonpartisan websites to get a sense for where the odds are of really most political things, election cycles. Biden's has a pretty decent size advantage over Trump. And mind you, Hillary Clinton had an advantage over Trump as well. But the difference is you're seeing Trump losing in a lot of key areas that he used to really have. The data was strongly in his camp before. So it's hard to imagine that given Biden's relative lead as it stands right now, in Trump's need to energize his base, which his base has been shrinking, just again, looking at the data, to get out there and vote, will there be enough Trump support given all that's gone on if history and data is correct, and that as we get closer and Biden maintains the lead, the market starts to go down? Will there be enough support in a declining market given all the things that have gone on with the everything that has come out of the White House over the past 4 years? Will there be enough juice left in the tank to put him over the edge? Because if there is, and Trump does end up winning, history and the data suggests unequivocally that the market will end up being higher. With a Biden victory, there are things that are going to end up changing. You would expect to see some of the things that are winning and leading right now to have to be repriced and struggle. You'd look at things that, where there's tax advantage returns like municipal bonds. You'd think with a higher tax environment that municipal bonds would create additional favorability. But Dan, we're gonna go through this month after month after month with your iBuyers, with their, all your real estate pros on this, on this forum. So definitely stay tuned to it. Right now, as it stands with Biden in the position versus Trump, you would think that the most likely course of action, given all that data, is that the market we would be finding our top right here at 3,200 on the S&P, and then we may struggle and slowly slide down towards November.
Got it. Yeah.
Now, a good debate where, Trump, if he really wipes the floor with Biden, maybe that's the thing that energizes the base and depresses the base for the Democrats. You get the Republicans out to vote, and then the market goes higher. We'll have to see. I don't even know when the debate is. I don't think they've announced one.
I don't think so either. Yeah,
Right.
I don't think so either. So, we'll close with interest rates, mortgage rates.
Yes.
Right? We talk about this a lot, and we've learned from you many times that, obviously mortgage rates are not tied to the market. They're not exactly tied to the market. Yep. Incredible, right? They're still incredible rates. New programs, banks continue lending. None of we haven't, even the pullbacks that we saw in jumbo have started to come back, right?
Yes.
So thoughts on mortgage rates and banking with regard to housing? Anything we should be looking out for there?
I got to have a chart for that. So I don't even know. I have to have a chart for that. Okay, so let's go to the chart. See the one says number 3. I don't even have time to show you 1 and 2, but what chart number 3 shows you here, and Dan, you can see that right with the arrow.
Yep.
Okay, so this is mortgage rates going back to the 60s. And if you look, this is, remember I said the baby boomers? Look, this is when the baby boomers were buying homes in droves. We look at where mortgage rates were. Right. And you can see where mortgage rates are now on a historical basis. And you're trying to get a sense for where do we go from here. There's a couple of ways to look at it. We know that mortgage rates aren't tied to the Treasury yield curve, but we do need to pay attention to where Treasury yields are because mortgages can, in some instances, have some sympathetic response to how Treasury yields are priced. And number one, if Treasury yields were to end up going negative, and there's growing consensus that may end up happening, maybe even on the short side. We've had the 2-year Treasury as low as 10 basis points. You're 10 basis points away from zero, you're 11 basis points away from negative. If we end up getting negative rates there, you might see a new paradigm shift with mortgage rates going even lower. But if you're looking for a more opportune time, if you, again, with the one exception being negative interest rates, if you're looking for a more opportune time to find an opportunity to refinance or to get that home and to find a new mortgage. You are not going to get much better than this. Look back on a historical basis. This is pretty much the bottom. This is it. You're not going to be getting anything that's new and or more egregious. You already have the Fed with an unlimited balance sheet buying mortgages in droves and keeping those mortgage rates as low as humanly possible. So
Right.
you've got the Fed buying, that's keeping rates low. You've already got the Treasury yield curve just about at zero, certainly on the short side. I don't know how much more you could possibly expect.
Yeah.
So what I'm going to tell you is, Dan, pay attention to the Treasury yield curve. If it does indeed end up going negative, we have a whole new thing to talk about. But for now, given that the Fed's already doing everything that they possibly can to keep rates low, I don't see how you get much better than this on mortgage rates.
Yeah, pretty good, man. Pretty
The
good.
history and the data don't suggest that it's going to get any better than it is right now.
Free
More
money.
favorable.
What's better than free money, right? Keep borrow. How much of that can we borrow? Well, Michael, thanks.
It's again, Fed said unlimited. They said unlimited, so we'll have to see.
That's what
Yeah, and again, I just want to point out the Fed balance sheet was at 3.9 trillion a few months ago in February. It's already over 7 trillion today. The expectation is that if this goes as long as people expect, that the Fed balance sheet is going to hit 10 trillion. All that money we've made up.
Wow.
We can't listen, we could do hours on this, but we're going to have to talk about what the cause and effect is of creating all that money. You can't, creating $7 trillion. That's right.
Well, Michael, thank you for hopping on with us today, of course, man. Remind everybody how they can find you.
You go to Manage the Funds on social media. You go to managethefunds.com on your phone or on your desktop, and then you find us, and then we're there.
There you are.
And then you get the information you need. You reach out if you've got questions, and then we'll provide you data support, answers, whatever it is that you need.
I appreciate your time again, man, and thanks for your insight. We'll follow up with you next month, and hopefully we have just continued great news to talk about.
You got it, Dan. Take care.
All right, thanks.
Bye.
Bye.